A very warm welcome to the first live session of Step 1 course. I am Natasha Surani, your host for today. We are delighted to welcome each one of you as we begin this journey to understand mutual funds, ETFs, and build a strong foundation in financial literacy. Moving ahead, it is my absolute pleasure to introduce you to our speaker, Dr. Ram, the founder of WealthCon and Nest Life Research. Dr. Ram is a practicing radiologist who turned his passion for finance into a mission to make every doctor and their family member financially confident and independent. I warmly welcome you, sir, to take the session forward. Over to you, sir.
Thank you very much and welcome you all. I presume that you all have watched all the previous video and we'll take it forward from there. We always say time is money, so we avoid wasting time of yours in doing a big introduction and so. Okay, you can read this. This is disclaimer which you already read on the brochure as well. Most important is that whatever we are going to discuss is only for the educational purpose, no investment advice involved. And the mutual fund which we take for the discussion are for the understanding purpose. It should not be considered as a investment advice. Okay, and the discussion and whatever I define, those are for practical purpose. This is not for the theory purpose or exam purpose. Okay. I already introduced you me in my videos. I'm IMP registered mutual fund distributor as well, but I'm not going to sell any regular plan because our mission is to empower you and become self-reliant in making financial decision. Okay, this is the brief introduction. Now, whenever you ask someone else which share or mutual fund I should buy, it is usually a wrong question. The right question is you have to tell the entire your story, and then there is a financial instrument. There are hundreds of financial instrument. So without understanding half story, investment advice suggestion is not a complete or correct thing. So I have written here that investor plus instrument is equal to investment. Okay. Now I already told you how to do financial planning, and investing is the major part. So we will not repeat the same thing. We have to move forward to the next discussion, and we'll focus more on mutual fund investing here. Okay, and this is general formula of investor plus investment as investment. Okay, so what are the factors you have to consider before choosing any instrument? Instrument means asset or any financial instrument. It is said that know thyself. That means you find out what you want and detail about you. So in next 1 hour, we will have some questions. I will show how to do the mutual fund analysis. There is not much PPT, just 1 or 2 slides. And you will take a pen and paper. I'll ask you the name of mutual funds and I'll analyze in front of you. Okay. So this is just before we begin the analysis of mutual fund. This is a very important slide. You can take a snapshot as well for your record purpose, but I suggest you write it down so that you will remember, because snapshot will remain in the memory of phone, not in your memory. So writing is much beneficial to memory. What are the investor related factors? And as I said previously that I teach to remember. Okay, so I made a mnemonic target, TARGAT. These are the investor related factors you have to write down in your note. Okay, so if you are investing any financial instrument, whether it is FD or shares or mutual fund, you have to write time horizon. Time horizon is generally classified into short term. Write down 1 year, less than 1 year is considered as a short term. Okay, for tax purpose, more than 1 year considered as a long term, but for investment purpose, more than 7 years considered as a long term. And between 1 and 7, you can say intermediate or mid term. So is this clear? From investing purpose, less than than 1 year is short. 1 year is time horizon is short term. More than 7 years is long term, and in between is a mid term. This is from investing purpose. What about tax purpose? Less than 1 year is short term, and more than one is long term. Okay, especially in equity. So you have to decide time horizon. Now you may ask why it is necessary. Suppose you want to go to buy grocery or vegetable in local market, and you go book the ticket of train. It will be laughable. Okay, so it's very simple. I got three photos here so that you will never forget. If you want to go for short distance, you take out the scooter or scooty. Okay, you don't you don't go into bus or train for short term. Short term means short distance. So you will buy the product which they invest into the money market and debt fund. These are the rules, and you have to follow this, because if you buy the investment product FD for long term, it is not going to create you wealth. For short term, it is always money market instrument like debt fund. FD is also FD, write down. Fixed deposit is also an instrument. Liquid fund is a debt fund. Okay, money market fund for short term. If it is long term, let's say you want to go for Delhi or Kolkata, then you go get the train ticket. You cannot go on scooter. So long term, it's equity. Equity means share market. Why? Because if you invest in equity for 7-8 years, you always get more return than FD and all other debt instrument. And in between, you can invest into the debt product. It is called as bond market. Okay. So now one more point you write here. Money market instrument are regulated by the RBI, Reserve Bank of India. Bond market and debt product equity market are regulated by SEBI, Security Exchange Board of India, because this instrument has less than 1 year expiry or duration. Write down. Less than 1 year maturity or duration money market instrument governed by the RBI. More than 1 year are governed by the regulated by the SEBI. Okay. So one thing is very clear: scooter and train. Long term is train for equity. Short term is debt product. Period. So time horizon decide which financial instrument has to be selected. Clear? Now this has to be very clear. Second, if you are 60 plus, 70 plus, this product is not suitable for you or person who is senior citizen. Reason: equity products are volatile, and if they invest and suddenly price goes down, then they don't have time to recover. Long term means equity investment, but the senior citizen may not be able to hold that for 7 years. So if age is young and goal is wealth creation, then equity. Beyond 60, less exposure to equity. So age is determinant of the investment. Second is risk tolerance. You have heard 100 times mutual funds are subject to market risk. But what is exactly market risk? Okay. Market risk means declining of the prices of mutual funds or shares because of overall generalized market decline. That is market risk. Suppose if you invest 10 lakh rupees and market collapse like COVID and it become 5 lakh. This is called as decline. Now this 5 lakh market will recover again and it will go 15, 20 as well. But temporary decline is called as volatility, and it is considered as a risk. So are you ready to tolerate on 20-30% rate portfolio? For risk, I call as a rate tolerance. Rate tolerance means portfolio is in a red. When you buy at 100 rupees and price goes down, it shows a red color. So rate tolerance. If you are not risk seeker or you don't want to take any risk, then which will be the product of choice to you? Is the safe product bond market. If you are ready to take little risk and hold for long term, equity product. So risk tolerance also decide the component how much you want to invest into the risky assets and safe asset. Then the goal of investing. Goal can be, as I said, there are three goals: parking of the fund, protection from the inflation, and growth. Parking of fund is this. You invest into the money market or debt product. For protection, where your aim is to get 7 to 8% return, debt funds, and here you want to get more than 10% return, equity product. So it depends upon goal of the investing. These are the investor rated factors which have to be taken into consideration before investing any financial instrument. Thereafter, expertise. So now, if you are a beginner, mutual funds need minimal knowledge. You don't need too much expertise. I believe that in next 3 weeks or 2 3 weeks, you will be have enough knowledge or expertise to select your own mutual fund and start creating portfolio. You don't need too much. For tracking the market means whether you have to see market every day. Answer for mutual fund is no. You don't have to see market every day. Not even every week as well. Once in a month is okay. Once in a month is okay when you are putting it, but otherwise no tracking is required. Expertise minimal required. Once this are there, then you can select the appropriate instrument. This is called as investment. Okay. So I discuss the investor related factors. Now, what are the instrument? So instruments means financial products or financial avenues, etc. Generic product or assets are debt asset, spelling as this T is silent. So we say debt. Debt, which includes bonds, bills, commercial paper, deposits, and so on. Equity product, these are the classes, 4 generic classes, asset classes, which are based on the shares. Then gold. Gold can be gold coins or gold exchange traded fund, sovereign gold bond. And fourth is real estate. We remember is as a grade. Okay. GAD. You can write down the mnemonic. How to remember this 4 asset grade. Real estate usually we don't discuss, but you for mutual fund you can discuss these 3. Now these are the generic product. You can buy it directly from the stock market, from jeweler or RBI, bonds, bills. But when we are investing through the pooled investment vehicle like mutual funds, so then there are multiple branded products. Now we know that in a generic medicine and branded medicine, generic medicine like paracetamol, branded medicine is Crocin, Dolo, and so on. So these are branded products, these are generic products. All branded products invest into generic product. So under the branded products, there is mutual funds, ETF, there is an NPS, new pension scheme, ULIP as well. We never ask to invest because they are very commission loaded products. AIF is also a new product. It is available for the HNI people who can invest at least more than 1 crore. AIF, that is alternative investment fund. Now, new fancy term is new fancy mutual fund type product is coming up called as specialized investment funds. Then there are PMFs. These are not under our discussion. We are discussing this. The reason I told you there are multiple reasons. Your almost all financial needs can be fulfilled by this simple products. You don't need fancy product. Okay, because there are a lot of choices, and that causes analysis paralysis, or it is called as paradox of choice. Okay, so this is one slide where we are going to discuss how to do mutual fund analysis. In this session, we are going to discuss how to analyze a single mutual funds end to end. Thereafter, we'll discuss how to screen. There are more than 10,000 mutual funds, and how to shortlist to make half dozen. Shortlisting or screening we'll discuss later on. Today, we'll discuss one mutual fund fully. Okay, that will create a base when you are doing the screening. So these are the points which you'll have to create on a notebook, and you are going to check each of this point. So category, there are SEBI categories when we want to check mutual fund. Then age of the mutual fund, write down. We recommend mutual fund which are more than 5-year-old. No NFO, that is new fund offer, or no new mutual fund, because we don't have any track record to do the analysis. They just have fancy brochure, but that is of no use. You have to have old mutual fund which is more than 5-year-old. Next is asset under management. There has to be at least 500 crores asset under management, because smaller mutual funds may not afford good mutual fund manager, or they might struggle. So remember, 5 years and minimum 500 crores asset under management. Then when we analyze, we see the portfolio asset allocation. Okay. I'm going to show, just let me finish this theory and then we'll go to practical. Okay. Asset under portfolio asset allocation, how much is equity, how much is the debt, how much is the cash, that we check. Then we decide this mutual fund is in which tax category. Okay. I'll discuss this in a later separate video, because this is very important for the people who have 30% tax bracket. Okay. There are three tax rates. One is equity tax rate, other is debt tax rate, and remaining is rest or miscellaneous, in which if you sell equity mutual fund less than within 1 year, tax rate is 20% on the capital gain. If you make a profit, then you have to pay tax. If there is no profit, you don't have to pay tax. But since you are a long-term investor, this is just hypothetical scenario where you are going to pay tax. But for longer period, equity tax rate is 12.5%. That means if you make 1 lakh rupees, you'll have to pay 12,500 tax. That is equity tax category. Second is debt tax category, where there is a slab rate. Whatever your slab rate is, accordingly you're taxed. And rest is again, if you sell within 2 years, it will be taxed as slab rate. If you sell after 2 years, it will be 12.5. So I will revise it again, so don't worry. But this has to be decided before you start investing. Okay. Expense ratio. Now today I'm going to decide, tell the what are the critical factors to decide whether to take mutual fund or discard. We want to invest in the mutual fund which has a low cost. In fact, whenever you do investment, you write down, this has to be your systematic way of analysis, any investment. First point is cost. Second point is tax. Third point is liquidity. Liquidity means how easily you can buy and sell. Fourth is risk. And fifth is return. Most of the people see only return, and return has to be seen at the end. So what are the parameters we have to check in any investment? Write down. Cost. Obviously, cost should be low. Otherwise, you will not make a good amount of return. So cost should be low. Second, tax. Obviously, tax we want to reduce, save tax. Liquidity means good liquidity. Risk means we want to have less risk, and return means we want to have more return. CTLR. So this has to be, you can apply this to shares, you can apply to the real estate as well, or gold as well. This is a general formula of any investment. So here we want to reduce the cost, and in mutual fund, costs are mentioned as the expense ratio. I discussed in one of the video. We avoid any mutual fund which has more than one expense ratio. Okay, 1% expense. That means we want less cost. Clear? We want the mutual fund with less cost, that is less than 1% expense ratio. Then I'll show the exit load as well. You have to be aware of, if you sell within 1 year, there are exit load as well. Exit load means like penalty amount. The way if we break the FD, there is some penalty amount as well. So there is some exit load if you break within that limit. And next is standard deviation. This is another interesting parameter. I'll make a separate video on standard deviation and tax rate as well, because this is extremely important in stock market. Okay, and it is also called as volatility. And also it is mentioned as the risk as well. So risk, we have to have less risk. That means less cost, less exit load, less tax, less standard. All are less. That's why I club them together to remember that all should be less. Because if they are more, we get less return. And last are the return parameters. So our mutual fund should have Short-Notice ratio more than 1, alpha more than 1, and return more than 1. Now this will also we discuss again separately. I'm taking now. You may say why I am taking this. So that this is not the in a sequence. This will be we have to take discuss in a different segments, or you can say patches. So first I'll discuss this, and in a next video, etc. I'll make a separate videos on this. Okay, these are the very important parameters. Now I want to show the analysis. Now tell me any mutual funds you are investing, and I'll take that only. Okay, write down the name of mutual fund which you want to. You have to write the name and entire name, SDFC, entire name. Then I can Parag, Parik, FlexiCap. Okay. So what we'll do today, we'll not do the screening. We'll do directly analysis one by one. Okay. So someone wrote Parag Parik. Let's start analysis of Parag Parik. Okay. As I mentioned, these are just for okay. When you type this is a value research online website. Parag Parik, let it come. Okay. Parag Parik FlexiCap. You open that mutual fund. Take a pen and paper, write one by one. Okay. I'm going to show each point what you want to say, what you should say. Which is the category here? I said category is written in the center. Okay. There is a nomenclature. First part is AMC. Second part is category. And third part is the either direct growth, something like mentioned. So this is the direct plan and FlexiCap. So first thing you will see category. Second is A. Remember this. Okay. Captis, CAAAP. Okay. Let's go in the same sequence. Next is age. Where is the age? Okay. Go down here and click on others. So there is some more information. Launch date is 2013. That means 12 years. You have to take check mark. Is this more than 5 years? Yes. Next is asset under management. Where is the asset under management? This is asset. And it has to be more than 500. It is too much. And in fact, 1 lakh, 1 lakh crore. So is it more than 500? Check. Is it more than 5 years? Yes. Next is CAAP. Okay, there is some exit load as well. Let's write down exit load as well. Okay, you write down exit load. What does it mean? If you sell within 1 year, 2% will be charged. If you sell more than 10% of unit, let's say you have 200 units of that mutual fund, and if you sell more than 20, let's say 30 units, then there will be charge. Okay, so this is self-explanatory, and since you are investing for a long time, this does not arise. Okay, you write expense ratio. Is expense ratio less than 1? Check. Okay, tick mark. All are tick mark. This is just for your knowledge. On this page you will learn. Now there are some other information as well. Just for theoretical purpose, you write down turnover should be less. This should be less. Okay, this should be ideally less. Should be 0, but they are having more. Okay, now next point you want to understand is you wrote the expense ratio, you wrote the exit load. Now let's go to the portfolio asset allocation, how much they are investing. Now you will have to click on the portfolio. Write down how much equity, how much debt, how much others. Debt. This is others, maybe cash, sometimes real estate, but main part are equity and debt. When equity component is more, there is a more chance of fluctuation. Okay, if debt component is there, it increase like this, and when it is combined, so fluctuation is reduced a bit. Okay, now whenever there is equity component is more than 65%, write down, it is considered as a equity for the taxation tax category. What is this? Equity category based on if it is more than 75%. So this information help you to decide which tax category is this. Second, it also decide you whether there is some debt component or excess entirely it is invested into the equity. Because when you do the asset allocation, it is important to do the asset allocation so that there is a less volatility in your portfolio. Next is, this will be in a tax category, equity category, because it has more than 65% of the equity. Then another, this is done. Now let's go to the standard deviation. Okay. For that, you have to click on the risk. Now this standard deviation, you see the standard deviation is 8.5. Now this standard deviation you will learn as we discuss further, but you can compare within the category. There is a benchmark as well as peer group. So whenever we want to assess whether it is a student's marks or the mutual funds or shares, we have to compare with someone. Either you can compare with the FD, or you can compare with the benchmark index, or you compare with the peer group. Okay. So here you can see that this is the standard deviation and it should be low, but it cannot be zero because this is equity component. Okay. In general, just for a round figure, Nifty Biz has, or Nifty 50 has usually 12% standard deviation. Okay, but it changes. It is not that 12. Sometimes if the market is volatile, it can go 20 as well. But usually it is 12% when market is under normal condition. So this is less than the Nifty. We check. Next is the short-term ratio. This should be at least more than 1. Is this more than 1? Yes. Alpha. Is this more than 1? So this is clear. This is clear. Now here we want minimum, but after experience you will understand which has less standard deviation, more standard deviation. So this has less standard deviation. So you did all checking and it is checked in the it is fitting into the all criteria. Okay. So these are the risk stats. Standard deviation is a risk parameter. Short-term ratio is the risk adjusted return. As of now, you just listen the words. Slowly, after a revision, by then the course you will understand how this is calculated and what does that mean. This is a risk adjusted risk return. How it is calculated? So they take the portfolio return mean, okay, portfolio return, average portfolio, minus FD return, okay, FD return. It is called as risk-free or FD return, and divide by the standard deviation. Not this standard deviation, but the downside deviation. Okay, but whenever there is adjusted means there is some division. We'll discuss the later on, but remember this should be more than 1, higher the better. Alpha is the excess return than the index. Okay, this should be at least 1 or it should be more than 1. Then we will go and check the return. Okay, click over here, then return. Under this return, what you can see is the 5 years. Okay, you don't have to go to the 10-year because the CB criteria has come around in 2017, 18. So old data is not that much relevant. 5 year, 3 year, 1 year. Okay, in this what you are doing checking is the 5 year return, and then there are can compare. Okay, if you click here, green is the index, blue is the fund. Is it, as of now it is giving more return than the index? Okay, for 5 years. What about 3 years? See, blue is more than index. What about 1 year? Blue. So here you see that fund is performing better than the index. Okay, now let's check the peer group. Okay, peer group average. So it is above the peer group in 3 year, 1 year, 3 year, 5 year. Okay, so this is performing better than the index and even category average. Okay, so this is called as a trailing return. Trailing return means from today backward 5 years. This is the 5 years, last 5 years from today. This is last 3 years from the today. That means if someone invested 3 years ago, how much his money would have increased by, his return would be 80% in 3 years. What about 5 years? Okay, his return would be almost 100, and his 100 rupee might have become almost 200 rupees, 300 rupees, because this is starting from zero. So if someone invested 100 rupees 5 years ago, now it will become 300 because it is 200% extra. This is trailing return. Now then there is discrete return, means what has happened in calendar year. For example, here in 2021, okay, this blue is fund and this is category. And so here this return we compare with the index or category. Our aim is to select the mutual fund which is better in the category and index. Okay. So these are the returns category, return parameters. If you want to see the in the category itself, you can see here in the 5 year. Okay. So this is a index benchmark. Here benchmark is BSE 500. Now who decides? It is depending upon which category. FlexiCap category has the Nifty or BSE 500 index. My question to you, this fund, has it given the more return than the index? Answer is yes, because it's 22% and the index is 20. And category, that is peer group category average is 20. That means it is definitely performing better than the index and this. Okay. What about 3 years? You can see this by yourself. So this is what our mutual fund is past, that it is performing consistently better than the index. This is the last criteria. Okay. It is consistently above the average return. Okay. These are the category which decide that this can be invested based on the all these parameters. What we are checking is the cost, risk, and return. So this is past. Someone is asking, what is brown? Okay, brown is category average. Let me explain this. So this is one fund. There must be 20, 30 in the category. So this is the category average, all the peer group, and this is the index. We compare with index, that is a better, and category as well, because we have to choose which is the best amongst them. Okay. Let me show a category here. If you go here, I'll show one category and then we will take another one mutual fund which is mentioned. So when you go to this, we are going to discuss later on this entire screen. Today we'll focus only on how to analyze single particular mutual fund. So for example, you are investing, you will find whether your fund has low cost, low risk, and high return. These are the 3 points you have to find it out. Okay, these are the, let's say, fund category. And if I select the flexi cap, you will see that. So you'll get the entire category. How many funds are in that category? Okay, almost 123 funds. Okay, so let's take another. This will come to later. Let's focus on one by one. Okay. Motilal Oswal, you have to write entire name. Motilal Oswal is the half name. Write the full name of mutual fund. जैसे surname होता है वैसे होता है. Okay, Nippon India Small Cap. Okay, let's take Nippon India Small Cap. If you want to analyze, you have to tell me full name. Half name से कैसे पता चलेगा? Okay. Nippon. We will compare with the category later on. Today, focus at least how to do single analysis of single mutual funds. Okay. Entire category we'll discuss later on. We have to go step by step. You will not understand everything in one lecture or one. It will take two weeks. So step by step, keep little patience. Okay, it is difficult to teach adult because adults just want to learn within one day. No, it is not. It will happen. It will take some time. Today you will something. Thereafter you will start understanding points. Okay, you have to keep patience. At least today, after this meeting, you will have that criteria. You can take a snapshot for a being. As of now, just focus on understanding. Okay, this is the, we can say, checklist of analyzing single mutual fund. Okay, checklist. So checklist. What is the category here? Small cap fund. That is a small cap direct. I explained you that middle name represent the category, and this is the company name, and this is the direct growth, and so on. Then you next step, after doing the your 5-10 mutual fund, it will become your practice. You'll know immediately where to go. Next is go to the other to understand age, AUM, expense ratio, and exit load. Launch date 23. Okay, not 23, 13. 2013 passed. Asset under management pass more than 5,000. Okay, expense ratio pass. So this pass here criteria checklist, it is less than 1, cleared. Asset under management more than 500 crores, clear. And it was launched in 2013, so it is clear. Now you see the exam. Now here is the exit load. What does it mean? If you sell mutual fund within 1 year, there will be 1% penalty, 1% of entire asset management. But when you are investing for long term, so this is practically not applicable. But you should be aware that this 1% might be deducted. Otherwise, you might wonder, I placed order, then why 1% or some amount is we are getting less. So what is the practical application? So either you will not sell within 1 year in the period, this lock-in period, or else you will be ready to pay that exit load. Okay. Expense ratio is the cost which is less than 1%, cleared. Okay. Now let's go to the portfolio and see, find out the how much is debt, equity, and others. Now you may want to say see the lower down portfolio, that you go later on. Don't go into that details, because if you understand everything, then you don't have to invest in mutual fund. You can directly invest in stock. For mutual fund, you don't have to be too much knowledge. Now here, what is the difference between previous and here? Can you write in the chat box? What is the difference? Now you are saying the EDC, equity, debt, cash. What is the difference between previous and now? Previously it was 75. Here it was around 20 approximately. And this. So here there is no debt component. It is an entire equity. What does that mean? Can you write it? What will be the implication of this? Implication means this will be more volatile because it has almost 95% equity. Okay. Next, which tax category is this? Write down in the chat box. Now I told you, if more than 65% equity, it will go to the equity category. Okay. If you go down, there is little more analysis of where that mutual fund is investing. Now you see this. This is what people कहते हैं ना, बोलने का कुछ दिखाने का. Mutual fund is small cap, but if you see the small cap investment is hardly 31%. They are investing in large cap, mid cap, and all this. Okay, so this is sometimes it is misnomer that just even if it is small cap, 100% is not invested into the small cap. Okay, only 31% is invested. But as of now, forget all this all portfolio. Focus only on the at least how much is the equity and debt. Next is go to the risk parameters and see the standard deviation. As I mentioned, if equity is more, standard deviation should be more. If you remember, Parag standard deviation, it was around 9, now it is 16. Write down, higher the standard deviation, higher the risk, but return can be higher as well. Okay. Checklist, is Sortino more than 1? Write down, check. Yes, since Sortino's ratio more than 1. Is alpha more than 1? Yes, checklist. Okay. Then there are other parameters as well. As of now, you don't go into that beta, sharpies. Too much is not required. Information ratio, only whatever at the beginning are told, that is enough. Okay. Then go to the return category and find out 5 years. It should be above benchmark and it should be above category. Otherwise, poorly performing, what is the use? So blue is the mutual fund, the what we selected, and green is index, and brown is category average. So you can see 5 year it is above index, above category. 3 years, I'm just clicking on there. Yes, it is still above. 1 year, still above. That's it. These are the 3 things you see. Then you can go down and see that whether 531, you don't check all this, okay, because it will be unnecessary headache to select. Focus only these 3. This is a mutual fund. this is a category. Okay. Sorry, this is a benchmark. Higher than the benchmark, higher than the category as well. And if you see the even in the ranking as well, there are 28, out of which it is rank is 8 out of this. That means it is above average. Average will be the 28. So 14 will be above, 14 will be below. So it is above average. Now here it has ranked 2. Here it is still above average. Okay. That means above average means if you divide by this 2, it will be centralized. So 14 will be the average above average. Okay. So this is how you select. So this is select. Now it's a standard deviation is high, but its return is also high. Okay. Dr. Manish is asking why it is showing high risk. Okay. So now you ignore all these parameters, risk, etc. Where is the risk? It might be shown here now. Okay. Let me show here. All equity will be mentioned as a high risk. High risk means high volatility. That's why they are considered as high risk, very high risk. No, riskometer, there are 3, 4, 6 colors. Okay, like this. If you remember. Okay, this. All equity funds will be shown in a high risk. Don't get scared. Okay, high risk is like a mutual fund will never become zero when it is diversified. It is just classified that based on the in the category or entire mutual fund, they are divided into 6 different risks, and all equity will be mentioned as high risk. That does not mean this money will go away. Okay, if you are investing for 7 years, this is just for understanding purpose, nothing yet. Now this is it. Equity, it will be shown as high risk. Here debt will be shown as here moderate risk, and liquid funds will be safe. So we can see this is one. This is where you remember PPG. Okay, that means you want to protect. If you want to park money, then you have to invest into the funds which are falling in this category, this risk status. If you want to create wealth and long term, then this will be falling here. And if you want to hold for 3-4 years and protect, this will be the parking. This will be protection from the inflation, and this will be the growth. Okay, so now this is a growth, protection, and this. चलो एक और लेते हैं, one more. So this is past. Quant small cap fund, quant. Now after when you do 10-20, you will automatically understand how these parameters are changing. Okay, small cap will have higher standard deviation, large cap has low standard deviation. But when you invest for long term, this does not matter too much. Quant small cap. There are more than 50 AMCs, out of which quant is. Let's focus on quant. So go in a same checklist, same sequence, because this is a systematic way of analysis rather than the haphazard. And once you do the systematic, then you will automatically understand the pattern, how these mutual funds are, the values are seen. Name small cap, category small cap. Then you have to select a age more than 5 years, expense ratio less than 1, asset under management more than 500 days. See exit load again here. Okay, so in this thing, is it passed or not, or this should be more than 5 years clear, this should be more than 500 clear, expense ratio should be less than 1 clear. Okay, now here just be aware. Next is risk. You have to just go in the same sequence and analyze 10 mutual fund. You will understand automatically. You don't need too much expertise in this. Or small cap, standard deviation 17. Now in a previous it was 16. Now it is standard deviation is 17. In Parag Parik it was 6 or 8. Okay, you see the pattern immediately. Is shortage ratio more than 1? Clear. Is alpha more than 1 year? Clear. Okay, let's go to the portfolio and find out the portion. 93% equity. That means that is the reason it has a high volatility. Go and check the return. Now these are the different. Here our objective is just to compare with index, benchmark, and category. Okay, absolute return is not the criteria. Now here let's check 531. Don't compare all return because you'll get confused. So now you can find it out yourself whether it is again blue, Now you may say जो भी म्यूचुअल फंड बता रहे हैं वो अच्छा ही है, खराब वाले भी देखो, देखते खराब वाला भी दिखा. Okay, so you can see this whether above category है कि नहीं. Now here in last 1 year, now it has gone below index. Okay, so below index, but still above the category. So that means you don't have reason to exit. Now here you see that what is happening here. 5 year it was topper. Out of 22 it came first. Out of 28 it came fourth. You can consider the number of students. And here out of 42, now it has 20 now. You may say why it is increasing, because companies are increasing every year. 5 years ago, there were around 20 companies. Now they are increased. Okay. Every year increasing. But you see the where it is recently, it is not performing good. But 1 year does not make. We usually see 2-3 years return. Okay. कोई खराब भी दिखाना पड़ेगा आपको. Let me show a bad mutual fund as well. या किसी का bad, you give me example. Let me see. I'm taking the example which you are mentioning. Now somebody is asking Kotak arbitrage. Okay, Kotak arbitrage. Okay, now this is a different category. Let's type Kotak arbitrage. Kotak arbitrage. Now this star mark from the value research, ignore that because that might be paid version. We have to do your own analysis. Arbitrage fund is a separate category. Okay, although tax category is equity, but it's you'll see the standard deviation. Okay, it's the standard deviation there. Just check mark. More than 5 years, yes. Asset under management, yes. Expense ratio, yes. Let's go to the risk status. This will be interesting now. See the standard deviation. Lower the zero standard deviation is like FD. FD has a zero standard deviation. It does not change. Now this is less than 1. So it is almost like FD only. So this is less risky fund. Its shortness ratio more than 1, check. Alpha more than 1, check. Standard deviation, it's very low. That means it is as good as FD. But what will happen now? The return is also like FD only. पहले 20% देते थे, now अभी तो 7%. So this fund can be used for what purpose? Parking of the fund. Parking money for 1 month, 3 months. So what should be the features of the mutual funds which is used for the parking? Standard deviation should be very less, maybe less than 1 or less than 2. Okay, that so that you will not have the less value than invested in a short term. Obviously, this is depend upon index, but this is major factor in parking your funds. Okay, then go and find out the returns. Now returns, when you do the returns, you are just comparing with the peer group. If you are not comparing with the absolute, in fact, it is good idea to compare with the FD as well. Okay, FD comparison, index comparison, and category comparison. Okay, because FD is also another vehicle where you can invest. So FD is better. Okay, so let's go and check the 5-year return. So this, there is no fluctuation. It is going like this. Like why it is going? Because it is special category, may be difficult to explain, but for practical purpose, write down arbitrage category. There are few points which are, this is a very unique or exceptional product. Arbitrage category. It's like safety like FD. Taxation is like equity where low tax is. Return is more than FD, slightly 1% more than FD. Okay, so arbitrage fund is alternative to FD because of tax efficiency, because equity funds are taxed at 12%, 20% short-term capital gain and 12.5% long-term capital gain. While FD, if you are in 30%, FD will have more tax. So this is a tax efficient alternative to FD. Okay, you can see the compare with the other things also. Okay, see this, and now you are not seeing any red here. Everything is green because they are it acts like a debt fund. So that is what I say. This is a very peculiar. It is taxed like equity, but act like a debt. Okay, ICICI multi-asset fund. So as of now, today we'll discuss passively managed fund, actively managed fund. Actively managed fund. We'll discuss index funds next time. because there are two types of fund: actively managed, passively managed fund. Actively managed fund, we need the mutual fund to perform better than the benchmark. The analysis of passive funds is little easier. That will do later on. Okay. Nippon India Multi-Cap Direct. First, you start analyzing single mutual fund, and once you get understand the pattern, we will understand. We'll discuss the category ranking as well. Nippon India Multi-Cap. Okay, Nippon India Multi-Cap. You have to do the check mark. This is a standard protocol. You don't have to use too much brain. जितना बोला उतना करो. कोई खराब फंड भी दिखाओ यार पहले. See, let's go to the 5 year, more than 5 year check. Asset under management check. Expense ratio check. Okay, this is done. Then risk status, in which we'll have to check this standard deviation alpha and alpha more than one checked. Shortage ratio more than one checked. Now see, the standard deviation is little lesser than the small cap. Okay, standard deviation is less. What about the return now? Brown is the category, green is the index, and blue is the fund. 1 year outperforming, 3 year outperforming, and 5 year outperforming. Okay, let me find यार some खराब वाला देखना है. So I have to show some bad as well. सबका सब good, that good क्या करेंगे? Let's show some bad mutual fund as well. Okay, large cap का दिखा देते हैं. I'm taking a little bigger screener. I want to show the poorly performing mutual fund. Whatever we discuss are very good, because you are investing in very good mutual funds. आप लोगों को अभी बहुत जरूरत भी नहीं है फिर. All right, so let me show a bad mutual fund as well. So it is taking time because there are more than 600 funds. They have to select. Okay, so now I'll show here. Okay, so now see this. इसको देखा दे, ये जो सैमको है, सैमको, सी अल्फा माइनस, इसको क्लिक करते थे. हाउ बैड फंड लुक्स लाइक. ओके, लेट्स चेक फ्रॉम द you go systematically. Okay, so in fact you reject here only. This is less than 3 years. Okay, expense ratio, it's okay. Now this is another criteria, it is getting rejected here as well. This is two criteria rejected, but nevertheless we'll see other things to reject. Go to the risk. Alpha minus 11. We need more than one. ये तो minus में चलेगा. Now shortage ratio minus. Okay. Now see the rank in category poor. Okay. Go to the return as well. See, this blue is very low in a which year? 3 years. 1 year. 3 years possibly होगा तो नहीं. So this is bad fund. Okay. If you are having such funds which is performing poorly and it is not fitting into all category, then that is a bad fund. So this is an example of bad fund based on what? All the category points which we mentioned here. This will help you. This slide will help you to analyze all points of mutual funds. This was rejected at the alpha and shortage ratio only. Okay, so start analyzing and finding out whether it can be rejected or not. Now, after analysis, what you will come to conclusion is reject and select based on the top, or maybe doubtful. Okay, thereafter. Okay, so I think we will stop here. Meanwhile, you try to read these terminologies on Google, and these are not too many, but there are few which are coming repeatedly that you can read. For example, words like equity, we mentioned equity, debt, shortage ratio, alpha. These are the few terminologies. You will have to make some efforts as well. Okay, all right, thank you very much, and I hope you enjoyed. Questions तो लिए थे मैंने, और कुछ है क्या? और कुछ क्वेश्चन है क्या? डाउट? Let's take 10 minutes. Doubt कुछ है क्या? Doubts of which is relevant. See, some doubts will be cleared as you go at the end of the course, because it is not possible to understand everything in one single video 1 week. So doubt will be there, but if any doubt which can Okay, alpha and beta. Forget beta. Alpha, we will have discussion. Totally in return. Some of the things are going to come repeated again. So even if you are not understood short noise ratio, alpha, don't worry. A standard deviation, we are going to make a video, so don't worry. A standard deviation. Can I change from regular to direct? Yes, after 1 month, you will change from the regular to direct. Next question is it true that as gets older, it performs better? No, there is no such thing. We have to compare with the index. There are so many questions. Okay. How many mutual funds should be in a portfolio? We say half dozen, never more than one dozen. So explain the ETF, MF. We are going to discuss ETF later on. Okay, don't worry. I think most of the queries which you are asking are going to be covered in a subsequent video. So we'll stop here. Don't worry. Most of your all queries will be vanish automatically when we discuss topics. Okay. Thank you very much.
Thank you everyone for joining, and a big thank you to Dr. Ram for valuable insights. Our next live session is on 17th October. Do not miss it. Until then, please watch assignment videos, and recordings of today's session will be available by tomorrow. Thank you once again.